My name's Mark John. I'm one of the mortgage advisors at Mewstone Mortgage Advice, and welcome to our video walkthrough to our guide, 5 schemes for first-time buyers. I'm going to give away a little bit more in this walkthrough. We've actually got a couple of extra schemes added on top to this guide, just to really nail your experience, your journey into buying your first property. And really this guide is specifically designed to provide you with as much information so you can nail and enjoy buying your first property. We want to give you as much information and educate you as much as possible so you can maximize your options as a first-time buyer. So let's jump straight into our guide. Why have we done this? So ultimately, we want to share as much information as we can with you, because buying your first property is a really daunting experience. There's so much information out there. It's completely overwhelming for first-time buyers. How much can you borrow? Which lenders offer the best deals? What schemes are available to first-time buyers? There's just so much information. If you've Googled any of this stuff before when you're looking at buying your first home, it's too much. It's overwhelming. So this was just going to give you a little bit of a snapshot of some of the things that you might be eligible for as a first-time buyer. Let's jump straight into the first scheme, which is shared ownership. So, what is shared ownership? You might have heard of it before under another name called part buy, part rent, and that's a really good way of summarising what shared ownership really is. In short, it's a government-backed scheme. It's aimed at making homes affordable for local people and helping first-time buyers get on the property ladder when they might be struggling to get on to buy a property in the local area. House prices are high, wages have naturally not kept up in line with the house prices rising over the years. So this is a great way of being able to get onto the property ladder when perhaps you can't afford to buy a property outright on the open market. Our advice is it's better to own some of a property than none of a property. So yeah, this shared ownership scheme, part by part rent, is a really good way of doing that. So typically you can purchase anywhere between a 25 and a 75% share of the property. It makes the whole process more affordable because you're only raising a mortgage on the share that you want to buy, rather than the whole price. So a really crude example could be, let's say you're buying a flat that would normally be worth 100,000. You could buy a 50% share for 50,000. So you'll only need a mortgage on that £50,000 share that you're buying. You pay a reduced level of rent because there is going to be 2 monthly payments you're making. Some is going to be for your mortgage and some is going to be the rent that's payable to a housing association. You can increase your ownership over a period of time. So it could be that perhaps you're at the beginning of a career, your income's lower now, but you're expecting pay rises in the future. So this scheme will allow you to increase your ownership as your circumstances allow it. And that process of increasing your ownership is something called staircasing. And it's very common for buyers to be able to buy a share now and then increase to full 100% ownership in the future. We help customers do that on a regular basis. So you will need to put down a deposit on a shared ownership property. Minimum deposit is generally going to be a 5% deposit, but you can already see that if you're only putting down a deposit on the share that you're buying, then that is a much lower level of deposit that you need to put down. So again, let's use that example, a £100,000 flat. If you're buying a 50% share for £50,000, you would only need to put down 5% on the £50,000 share that you were buying. So that's £2,500. So a significantly lower deposit than if you were buying that property for £100,000 on the open market, where that deposit requirement would be £5,000, so double the amount. So yeah, a much, much lower level of deposit and a lower level of mortgage needed. That's going to be especially helpful if your income isn't as high because of the stage you're at in your career, or if you're buying a property on your own. So a bit more about shared ownership and how it works. So the first thing is first-time buyers are eligible for shared ownership. There are a few sort of rules that you must be aware of. So your income cannot be any more than £80,000. It is a higher level of £90,000 if you're buying a shared ownership property in the London area. The property must be your own home. So you can't rent this property out. It's going to be a property for you to live in. Benefits to first-time buyers, so it's really obvious. We've just said lower level of mortgage borrowing, so lower income earners could be eligible for it. Lower level of deposit, because you're only putting down a deposit on the share that you're buying, making that whole process of getting on the property ladder potentially quicker to do. You've got this option to buy shares later, as we said. So a few things to consider. You'll pay a combined payment made up of mortgage to your mortgage lender and rent to the housing association. And just to provide you with a little bit of information about housing associations. So they're not like a typical landlord, where a landlord that you're renting from privately can increase your rental payments ultimately as they see fit. If their mortgage goes up or they want to charge you more, then they will increase your rent. There's not a lot you can do about that. A housing association is very different because they are a not-for-profit organisation, and there are set government rules in place to protect homeowners under shared ownership. So yes, rents will increase, but it will generally be in line with inflation and not above that amount because it's a non-profit organisation. Selling your property on shared ownership can be a more complex process. So if you buy a shared ownership property and you want to move in the future, perhaps you want to upsize or move to a different area, you can sell your shared ownership property, but the buyer must be eligible for shared ownership. So again, you are potentially selling your property only to first-time buyers. There are some other exceptions to that, but generally speaking, first-time buyers are who you're going to be selling that property to. So you are narrowing down who you could potentially sell the property to. So you need to take that into account. They need to be eligible for shared ownership. As I said, a great option for first-time buyers that are struggling to afford a full mortgage or afford to buy a property on the open market. So it's just a great way of being able to get onto the property ladder. So that brings us on to our second scheme, a scheme called Joint Borrower Sole Proprietor. For the purposes of this walkthrough, I'm going to abbreviate it to JBSP, just to make it easier because it's such a mouthful. So what is a JBSP mortgage? In short, a JBSP mortgage allows a first-time buyer to borrow money with another person, but crucially, the other person doesn't own the property. So a great example of this could be a first-time buyer going on the mortgage, but their parent going on the mortgage as well. So why would you want to do something like that? Again, could be that you've got a limited income as a first-time buyer and your parent has a good income, they already own their home, they've got no mortgage or no commitments, and they want to help you get on the property ladder. Both the first-time buyer and the parent's income can be used to boost your affordability, to get you that mortgage, increase potentially the amount of money that you can borrow so you can buy a more suitable property. A great way of being able to get on the property ladder using somebody else's income. But the really crucial part is they don't own that property. So the parent doesn't own the property, they don't go on the mortgage deeds, and the first-time buyer is the sole owner of that property. Really great scheme. So, first-time buyer owns the property outright, but you're using your parent or another family member's income to boost your affordability, to help you borrow that bit extra to get a more suitable property. Already said, you combining both persons' income, there could be some minimum income requirements for the first-time buyer. It typically needs to be a family member, and a parent is a great option, an auntie, an uncle, a grandparent, but there are some lenders out there that will consider non-family members as well. As I said, the first-time buyer crucially has full ownership of the property. They are the sole person on the mortgage deeds, the sole person that has rights to equity in the property effectively. But the extra borrower, the parent, the family member, they are liable for that mortgage. So whilst they don't own the property, they are acting almost like a guarantor in a way. So who can be the additional borrower? So typically a close family member, as I said, a parent, a grandparent, an aunt, an uncle, a sibling. That's not to say that it has to be a family member, because there are some lenders out there that might consider a non-family member, but you're narrowing down your options basically. That non-family member must meet affordability guidelines and they must be creditworthy. So the lender is going to assess their ability to afford taking on that mortgage as if they were taking out a normal mortgage. So they look at, do they have a mortgage? Do they have any commitments like loans or credit cards? How old are they? That new mortgage, this JBSP mortgage, needs to be affordable based on the first-time buyer and the additional borrower's circumstances at the time of applying. So benefits for first-time buyers. As we said, we're increasing the borrowing capacity by using an extra person's income to boost their potential mortgage borrowing. There is no additional stamp duty. So at the moment in the UK, at this time we go into press, if you own more than one property, you will pay an increased level of stamp duty. But on this scheme, even if the parent is going on the mortgage or the family member is going on the mortgage, there will not be an increased level of stamp duty because crucially, they are not going on the deeds, they don't own that property. So first time buyer stamp duty reliefs, which are very common, that will still apply as the first time buyer is the sole owner of that new property. A full ownership is with the first time buyer, so that person, the first time buyer, owns the property in their sole name. So yeah, really good scheme. There's the ability in the future that the first time buyer circumstances now allow, they can apply for a brand new mortgage, a traditional normal mortgage, and they can remove the parent, the family member off the mortgage and remove that extra person's commitment from the mortgage payments. So things to consider. Yeah. The supporting person, the family member, if it is a family member, is liable for those mortgage payments. They are committed to that mortgage. They need to ensure that all payments are made up to date. If that person wants to borrow money somewhere else in the future, could be applying for a car loan or buying a new property, this mortgage is going to show on their credit file as an ongoing commitment, and that will need to be factored into any further borrowing requirements that the extra borrower, the family member, has in the future. It's a great scheme for first-time buyers to be able to get on the property ladder, secure a property that's suitable for them now, even if their circumstances don't allow for it right this moment, and they can look to change things in the future. On to our next scheme called Deposit on Lock. Deposit on Lock. What is this all about? So, specifically, this is a scheme for new build properties exclusively. It allows first-time buyers to purchase a new build property with just a 5% deposit. Now, you might be thinking, well, surely that's just the norm. 5% deposit mortgages are available everywhere, and that is absolutely correct. But when you move into new build properties, lenders can restrict the level of deposit that is required as the minimum in order to buy a new build property. So why would that be the case? In theory, new build properties are more susceptible to a thing called negative equity. If house prices fall in the market, new build properties are affected more because they tend to be a little bit more expensive than buying second-hand homes. And quite rightly, they're brand new. It's very common for a new build property to cost a bit more. But for that reason, it's very commonplace that lenders, mortgage lenders, insist on either a 10% deposit, a 15% deposit, and again that deposit requirement can increase if it is for a flat as opposed to a house. So some lenders will insist on a 20% deposit for a new build flat. So what Deposit Unlock does is it allows first-time buyers to secure a new build property with just a 5% deposit. That's going to make buying a property much easier because you've got a lower level of deposit required. Really useful on new build properties. So as I've said, 5% deposit. If you are buying a £300,000 property, you only require a 15% deposit, as opposed to 10%, which could be £30,000. 15%, it could be £45,000. Huge amounts of money. It's only available on new build properties, as I said, and it's only available between certain mortgage lenders and certain new build companies that are working closely together to help first-time buyers buy these specific properties. So lenders take on a bit more risk because they are effectively going to allow first-time buyers to secure a mortgage on a new build property with less deposit. There's no government scheme involved with this as well. So there was a previous scheme called Help to Buy which had government involvement, but because that is removed from this particular first-time buyer scheme, there's no additional red tape, process, legal work to go through, which makes the process easier and quicker as a buyer. Available to first-time buyers, it's available across England, Wales. It's for new build properties only. as I said. And why would you want to consider something like a new build property over a second-hand home? So new build property is great. I bought myself a new build property when I was a first-time buyer about 10 years ago now. Brand new roof, brand new kitchens, brand new bathrooms, 10-year warranty. So you've just got all of this additional security on a new build property. And yeah, if things go wrong with the property, it's covered by that warranty. So it's really, really worthwhile considering a new build property as a first-time buyer, especially when they are energy efficient. We often find that mortgage lenders are keen to incentivize customers buying energy efficient homes, and new build properties come under energy efficient homes, so they are cheaper to run from a gas and electric perspective, making them more economical, and lenders will reward first-time buyers with lower interest rates, which in turn means lower mortgage payments if you're buying a new build property. So another reason to consider new build. It's only available on new build, so you can't use this scheme for second-hand homes. Not all developers and not all lenders offer this scheme, so it is a narrow part of the marketplace. And if you're only putting down a smaller deposit, as a rule of thumb, interest rates can be a little bit higher. So a 10%, 15% deposit will naturally attract a lower interest rate, whereas a 5% deposit, it's high risk for lenders, so the rates can be a little bit higher. So that takes us on to our next scheme, the 0% deposit mortgage. Now, there are a few versions that are coming out of this. I'm going to walk you through a specific scheme called the track record mortgage. But there are a few different 0% deposit mortgage schemes that are becoming available now. What is a track record mortgage? Very simply, this mortgage is designed to help people that are first-time buyers, that are renting, get on the property ladder. Really, the idea behind it is renting and saving a deposit is a really challenging thing to do because rental payments are quite high. So being able to save extra money to build up that level of deposit needed to get on the property ladder is a massive challenge. With this scheme, you can use your history of making your rental payments on time as a way of evidencing your creditworthiness and your ability to pay a mortgage. So how does it work? No deposit needed. It's a 100% mortgage. You use evidence that you've made your rental payments on time in full for ideally 12 months through your bank statements, through your tenancy agreement, potentially a reference of some kind to prove your creditworthiness. It helps you, as I said, get on the property ladder if you're struggling to save enough money for a deposit because your rental payments are so high. It's aimed at first-time buyers. You need to be renting for at least 12 months and you need to have a really good credit history. Any missed payments or late payments are likely to cause your application to be declined. If you could prove your rental payments via bank statements or references, you're going to be eligible for this scheme. Why would you choose a track record mortgage? Very simple, no deposit needed, so you can make home ownership happen much sooner. You can use your rental history as a way of evidencing that you are a good, responsible borrower, but you need to consider the following things. You must have a good credit history, almost the best credit history that you can get. So low levels of debt, paying bills on time, no missed payments, no arrears, no credit issues in the past. We need to obviously highlight that this is not a scheme that's available with all lenders. This is available with a small handful of lenders, so your options are limited. I'm going to walk you on to our next scheme, the Helping Hand Mortgage. Let me tell you a little bit about this scheme and how it works. So this mortgage scheme, the Helping Hand Mortgage, is available through Nationwide only. This is a scheme specific to them as a lender. It's aimed at providing borrowers with a higher level of borrowing or a higher level of income multiple to boost how much money they could borrow on their mortgage to buy a more suitable property. How does it work? Typically, most mortgage lenders will cap borrowing at 4.5 times your income. But with this scheme, you could potentially borrow up to 5.5 times your income. It's not only for first-time buyers in the truest sense. If you've not owned a property for the last 3 years, under Nationwide's rule, you'd be classed as a first-time buyer. But it is aimed at people that have not owned property for the last 3 years, a first-time buyer. So yeah, let's talk about it a bit more. It's available with a 5% deposit. You must choose either a 5-year or a 10-year fixed rate on this scheme. There are no 2-year fixed rates available on this scheme. A few other things to consider. You must have a minimum income at the time of going to print of about £40,000. Having said that, Nationwide have changed the goalposts on the minimum level of income required over the last 12 months, in a good way and in a negative way. So watch this space, because it could be that their ruling around this has changed. But the good news is that £40,000 can be made up of different elements. So it could be perhaps if you've got children, child benefit, perhaps some tax credits, perhaps it's overtime, perhaps it's commission. It doesn't just have to be a salary. If you're a joint applicant, so there's 2 of you, then 55,000 is the minimum income. But again, your income can be made up of different elements: overtime, commission, bonus, child benefit, for etc. Unfortunately, you can't qualify for the scheme if you're self-employed. You have to be in an employed PAYE role. Things to consider: you're going to need to pass the affordability checks in order to qualify for the higher level of borrowing. This scheme is only available through Nationwide, and in addition to that, you are forced to choose either a 5 or a 10-year fixed rate. There are no other alternatives available. So that takes you on to the next scheme, the first-time buyer boost mortgage that's available from Halifax. It works in a similar-ish way to the scheme with Nationwide. Let me walk you through it. Again, it's aimed at providing you with a higher level of borrowing, potentially up to 5.5 times your annual income, making it easier for you to achieve a higher level of borrowing and buy a more suitable property as a first-time buyer. To be eligible, one person must be a first-time buyer, but crucially, neither of you can own a property if you're buying as a couple. You must have a total household income of 50,000. So if you're buying on your own, a higher level of borrowing compared to Nationwide's deal. But if you're buying as a couple, a slightly lower level of income. Now, if you are a couple, you're both on minimum wage, you should potentially qualify for this deal, because the minimum income for national minimum wage for adults is around about £25,000 now. Difference here is you must have a 10% deposit to qualify for this scheme. You might have to have more money for your deposit, but you might be able to borrow more on a lower level of income in comparison to Nationwide's deal. And again, this scheme is for employed customers only, not for anybody that is self-employed. And this leads you on to our last scheme, the £5,000 deposit mortgage. Let me tell you a bit about this scheme, because it works slightly differently. So, £5,000 deposit mortgage is a scheme that is available through Accord Mortgages, and it allows you to buy a property of up to £500,000 with as little as £5,000 deposit. So if you're buying all the way up to £500,000, that is a 1% deposit. But crucially, £5,000 is the minimum that you need to put down. We've just helped a customer buy their first home using this scheme, bought a property for around about £400,000, and were able to get on the property ladder with just a £5,000 deposit. So low level of deposit is the key requirement there. You can potentially borrow up to 99% of the value of the property. There is no minimum income level, but you need to fit strict affordability guidelines. You again will only have the choice of a 5-year fixed rate, and at the time we go into press, it's 5.99%. As I said before, at least one person must be buying their first home, but crucially, you can't own a property at the time of applying. It's not available for new build properties. It's not available for flats. It's available on second-hand homes, houses specifically. It's available across England, Scotland and Wales. Strict credit checks apply to this mortgage deal. So that brings us to the end of our guide, 5 schemes for first-time buyers. But as you can tell, it's not just 5 schemes included within this. This is an overview of schemes that you could be eligible for as a first-time buyer. If you'd like to further support, advice, you can check out all of our material on our socials, or reach out to us directly for a no obligation appointment where we could tell you about what your specific options could be. Thanks for listening.